Think about saving money or building wealth through taxes. You probably think first about a business. And it's true, business owners have a number of tax strategies they can use to their advantage depending upon the structure of their company. For example, they can decide to take income out and cash flow out in different ways. They might choose to take it through salary, take it in the form of company stock, take it in the form of dividends, or have their income deferred into a pension plan especially designed to maximize that business owner's benefits. But employees of a company, however, have significantly fewer such options. And of course, the one most workers take advantage of and are familiar with is investing in 401ks. Let's face it, in theory, the very best investment tax-wise would be one in which you can make pre-tax contributions. Then you wouldn't have to pay any taxes at all on the interest or gains as your money grows. And ultimately, you'd be able to withdraw it all tax-free. Of course, as you know, the only problem with that investment is it's too good to be true. It simply does not exist. But the next best thing in the eyes of most workers is their 401k. The only trade-off between it and that non-existent investment is that a 401k lacks the last benefit. Yes, you do get pre-tax contributions. And yes, you do not have to pay taxes on the money as it grows. But unfortunately, yes, you are taxed when you withdraw the money. A good analogy here is if you were a farmer and you were given a choice between paying taxes on the seed you plant or paying taxes on the harvest you sell, which would you choose? Well, with a 401k, you're choosing to wait and pay taxes on the entire harvest, and you're getting your seeds tax-free. To put it in terms of actual numbers, let's say that you're in the 30% tax bracket, and each year you put $10,000 into your 401k. Because it's a pre-tax contribution, it actually costs you $7,000 because the government is putting in the other $3,000 on your behalf. Yes, you're going to owe taxes on the whole thing in the future, but meanwhile, all that money is sitting there compounding and accumulating interest and not being taxed. So it's kind of sort of like an interest-free loan from the government. So the question becomes, so what then would be the equivalent of paying taxes on the seed rather than the harvest? And might that be a better option for some? The answer to the first question is a Roth IRA, which in many ways is the strategic opposite of a 401k. You don't get to make a pre-tax contribution, but your withdrawals will be tax-free. As for which might be preferable for you, that depends on several variables. The first is how much you or your advisor believe that tax rates are likely to increase in the future between now and the time you withdraw your money. If your tax rate between now and the time you withdraw your money only goes up from 30 to, let's say, 35%, for example, then deferring taxes for 30 years with a 401k could very well be the best option. On the other hand, if taxes go from 30% all the way up to 50%, then you probably would be better off paying taxes on the seed, in other words, using the Roth IRA instead of the 401k. But not so fast. Why? Because there's another variable to consider here, which is how much time you have to let that $3,000 that the IRS is loaning you grow. It may be 30 years, but it might only be 10 or 15. As a general rule, the longer the time, the less the tax rates have to increase in order for the Roth IRA to make more sense. To put it simply, if you have either a lot of time for your money to grow tax deferred, or you think tax rates are going to go up a lot between now and retirement, you might very well be better off paying taxes on the seed rather than the harvest. In other words, maybe the Roth makes more sense strategically than the 401k. But that decision has to be unique for every individual. But not so fast again. Another reason most workers and advisors almost default to the 401k is that the Roth has more limitations as to who can use it and how much they can contribute. For example, the limitation on the Roth IRA currently is $5,500 if you're under the age of 50 and $6,500 if you're over the age of 50. And if your income's over a certain threshold, approximately $133,000, then you're ineligible to open a Roth IRA anyway.